We're kicking things off this week in what our market intelligence is calling slow grind higher mode.
Okay.
I mean, just look at the numbers. The S&P 500 is up, what, 0.23%? NASDAQ up 0.15%. The Dow is barely moving.
It's quiet, almost too quiet. The market surface is just whispering, but underneath all that, the policy and regulatory world is basically shouting.
That's the paradox, isn't it?
It is. We have a whole stack of curated sources that are all pointing to where regulators are focusing their energy. They're trying to lean into where the next set of, structural risks might be building up, even while the indices are just sort of drifting up.
And that's really the mission for this deep dive. We want to uncover that structural friction that's building up just beneath that quiet tape. We're going to be synthesizing intelligence across really three very different but high-impact areas.
We're talking about the geopolitical squeeze on the AI supply chain.
Right. And then this quiet but really critical issue with bank capital quality.
And finally, the new policy pressure that's hitting pricing power in the real economy.
Our sources are showing these aren't just isolated stories. They all kind of connect to show why the quality of capital matters just as much as how much there is. And maybe why the era of just, slapping a premium on everything is probably coming to an end.
It's a big shift.
Okay, let's unpack this.
Let's start with the clearest positive flow driver of the week, NVIDIA. They managed to secure presidential approval to sell their next-gen H200 AI chips into China. It's a huge potential restoration of access for them. It gives management a path back into a market they think is worth around $50 billion.
So on the surface, that sounds like a pure win for earnings, but
Yeah.
the conditions attached are fascinating. It feels like they signal a major shift in strategy.
Oh, absolutely.
It's not a full block, but it's an agreement that's subject to a hefty 25% surcharge and really tight customer screening. What does that move tell us about the administration's thinking here?
It signals a tactical pivot. It's really smart, in a way. Instead of a hard, blunt denial, which, just frustrates U.S. chip makers and, frankly, speeds up China's own domestic alternatives.
Right, it forces their hand.
Exactly. So instead, the administration is choosing to tax the export of this cutting-edge AI. It's a political tightrope walk. They're trying to slow the tech transfer and capture some economic value at the same time.
But the big question, the immediate uncertainty, is whether that tax actually works. Or is it just a signaling move? I mean, why would Beijing agree to pay a 25% surcharge when they're pumping massive state funding into their own alternatives, like Huawei's chips?
And that is the core tension you have to track. The market is cheering the conditional access. But China still controls the final demand.
Of course.
If they look at that 25% and say it's too high, or if it just makes them double down on their own chips, well, then that $50 billion market access becomes largely symbolic.
And we should expect this for everyone else, too. AMD, Intel.
Yeah, you should expect very similar conditional terms for them. This is basically the new template for high-tech exports to China.
Okay, so shifting gears a bit. The regulatory friction is now moving beyond the physical chips and into the content used to train the AI itself.
That's right.
Brussels has opened a fresh antitrust investigation into Alphabet, into Google. And it's specifically targeting how it sources and uses web and YouTube content for its big models, for things like AI overviews and Gemini.
This is a massive regulatory headwind. I mean, it goes right to the core cost structure of these large language models. The EU is essentially asking if the terms Google gives to publishers are fair.
Right, were they forced into bad deals?
Exactly. Were they forced into these agreements? Were they locked out of easy opt-outs to stop their content from being scraped? Or, and this is the critical part, did they face the threat of losing search visibility if they didn't just play along?
And this investigation is happening on top of all the other massive legislation that's already out there, like the DMA.
Precisely. This probe sits right on top of the Digital Markets Act, the DMA, which is already designed to rein in these big tech gatekeepers. What this new AI investigation signals is that monetizing AI is going to be fundamentally constrained by debates over compensation and consent.
Not just tech capability.
Not just tech capability. Publishers are saying, hey, you need to pay us for the data that's driving the next generation of your earnings. The regulatory discount on Alphabet's future AI profits, it's probably going to keep growing.
So if geopolitics constrains the chips and EU policy constrains the software, then it makes sense everyone is rushing to diversify where they actually make this stuff. We just saw Intel make a pretty big move in India.
A very clear direction of travel. Intel and Tata Electronics signed an MOU for Intel products to be manufactured and packaged at new Tata facilities.
This isn't about replacing East Asia, though, right?
No, it's about complementing it.
Yeah.
The focus is on AI-ready PCs, serving that huge local Indian market,
Yeah.
and, strategically lowering the geopolitical risk that's all centered on Taiwan and other key hubs.
And then the last piece of this tech puzzle is ambient AI hardware. This is a huge revenue success story that seems to be flying straight into a regulatory wall.
You're talking about Meta's Ray-Ban smart glasses.
Exactly. Sales have more than tripled year on year. They're planning to ramp up to 10 million units a year by 2026.
And this is the test case. It's a crucial test case for how regulators are going to handle this kind of ubiquitous ambient AI hardware in public. These glasses are capturing continuous photos, videos, maybe even live streams.
Which brings up the friction point.
The friction point is bystander consent and data usage. EU officials, privacy advocates, they're laser focused on this.
So if regulations force Meta to implement some kind of really onerous consent mechanism, like the glasses have to shout, "I'm recording," every time you use them in public,
then it puts a hard cap on their growth. It doesn't matter what the consumer demand is. If strong regulatory guardrails are put in place to protect the privacy of people not wearing the glasses, the whole goal of making them a mainstream everyday device gets very, very limited.
So, okay, that was a pretty comprehensive look at the friction in the tech world. But if we shift from tech balance sheets to bank balance sheets, we find a different, much quieter kind of risk building up. It's far away from the headlines. This is about the hidden problem of bank capital quality. The term our sources are using is synthetic risk transfer, or SRT.
This is exactly where the quiet tape hides systemic vulnerabilities. The quantity of capital held by banks looks fine. It looks great on paper. But global banks, especially in Europe, are using more and more of these synthetic risk transfer deals.
And that's basically just buying insurance on their own loans.
Right. That's a great way to put it. They're buying insurance on slices of their loan books, say a portfolio of corporate loans or a chunk of mortgages.
And the goal for the bank is efficiency. They buy this insurance and suddenly they can reduce the amount of equity capital they're required to hold against those loans.
Precisely. It frees up room to lend more, and it dramatically flatters their return on equity numbers. It makes the bank look way more profitable and less constrained to investors. It's pure capital arbitrage.
So they're replacing real, permanent cash equity with a promise from an insurer. What's the fundamental downside here that our sources are flagging?
The problem is the quality and the duration of that protection. The sources are warning that the protection is often very narrow. It only covers a small slice of potential losses. And critically, it is highly opaque.
Opaque how?
Even the bank supervisors struggle to track who exactly is taking on this underlying credit risk.
Yeah.
And that makes modeling systemic exposure almost impossible.
And the most dangerous part seems to be the maturity mismatch. They're using short-term insurance to cover long-term risks.
Think of it like this. A bank issues a big corporate loan that matures in, say, 7 years. To reduce the capital they need, they buy an SRT product that insures the first 5% of losses. But that insurance policy only lasts for 3 years.
Ah, I see.
For those 3 years, the regulatory box is ticked. The bank holds less capital. But when that insurance expires, the bank suddenly has to post full equity against that loan if they can't find a new insurer, or if the risk environment has gotten worse.
Which creates a sudden demand for capital at the absolute worst possible moment.
At the worst possible moment. When credit markets are already stressed, it could force a sudden systemic shock instead of a smooth adjustment.
And who's pushing back on this?
This is exactly the concern being raised by the European Central Bank. The ECB is leading the global regulatory pushback on this. They much prefer old-fashioned true sales securitizations where the loan is actually sold off the balance sheet.
Because that truly transfers the risk out of the banking system.
It truly transfers it. The ECB is sounding the alarm, specifically warning that these unfunded synthetic deals with insurers risk recreating the opaque linkages we saw before 2008.
Where risk didn't disappear, it just moved into a dark, unregulated corner of the system.
If we connect this to the bigger picture, the ECB's worry is you're just outsourcing default risk to these potentially highly leveraged counterparties like hedge funds or specialized reinsurers, and they might just fail to pay out during a major stress event.
So the ultimate investor takeaway here is powerful. It really forces you to look past the top-line capital ratios.
The key message for you, for the learner, is that capital quality matters just as much as capital quantity. When bank earnings look great because their regulatory capital has been synthetically lowered, you are effectively being paid to underwrite more fragility than those headline ratios suggest.
You have to ask, is that cushion real, permanent equity, or is it a fragile promise backed by some opaque third party?
Exactly.
That insight on hidden financial fragility it's the perfect bridge to our final segment, because now we're seeing policy deliberately creating friction and pressure on the pricing power of real economy companies.
Hmm. The post-pandemic era of easy margin expansion, just hiking prices, it's clearly fading. Pricing power is now being treated almost like a political liability, especially in sectors that really hit household budgets.
Food, transportation, agriculture.
All of them.
So let's look at the U.S. administration's dual approach to agriculture. They paired a big $12 billion relief package for farmers with a lot of public pressure on equipment makers, like Deere, to lower prices.
This is a highly strategic move. The relief package helps the farmers' cash flow, but the public pressure is designed to lower their input costs. And our sources explain the mechanism for getting those lower prices involves proposing looser environmental standards.
So wait, how does that actually work? How does loosening environmental standards translate into a measurable cost saving on something as complex as a tractor?
Well, highly regulated environmental standards require these complex, very expensive components in heavy machinery. Think specialized urea injection systems, advanced filtration. These things inflate the manufacturing costs significantly. So by signaling a willingness to reduce those regulatory burdens, the administration is offering an indirect cost-saving lever to a company like Deere, with the expectation that those savings get passed down to the farmer. It's a trade-off. Relaxed regulation for better affordability.
And that pressure isn't just on heavy equipment. We're seeing it dramatically in consumer staples, which affects, every single grocery cart in the country.
Look at PepsiCo. After a lot of pressure from activist investor Elliott and responding to households with stretched budgets, PepsiCo agreed to rationalize its product lineup, cut costs, and crucially, reduce prices on selected foods.
This is a huge signal that the decade-long strategy of just premiumization is being challenged.
Absolutely. For years, the way you grew in consumer staples was by convincing people to buy the slightly smaller, slightly better packaged, higher margin version of the same thing. What the Deere story and the PepsiCo story both tell us is that we're in a new environment where that easy pricing power is under a microscope.
So the overarching trend is clear. Volume growth now has to be earned through affordability, not through premiumization.
Which is going to fundamentally change how you value these so-called defensive stocks. Investors now have to watch earnings reports so closely to see if volume elasticity, the higher demand from lower prices, is actually strong enough to offset thinner margins.
If that volume bump is weak, these highly valued defensive companies are going to look a lot less safe than the market assumes.
A lot less safe.
Wow. We've covered a huge amount of ground here where structural risk and friction are quietly building. The geopolitical limits on AI hardware, the growing discomfort with synthetic bank capital, and this new political pressure on pricing power.
These are the three core structural shifts that I think are going to define the market in the year ahead. And as we look at the immediate horizon, two questions really stand out. First, that 25% surcharge on NVDA chips. Is China going to play along? Will it be a real revenue bridge, or will they just accelerate their domestic pivot and make that approval kind of symbolic?
And on the global stage, that scrutiny on capital quality isn't going away. If the US and UK follow the ECB's lead on synthetic risk, it's going to force major banks to hold more high-quality equity, and that would pressure earnings instantly.
If we connect this to the bigger picture, understanding these structural frictions lets you see where the market is most vulnerable to a shock. The quiet tape often comes before a big repricing, and those repricing events usually come from policy or regulatory surprises, not just, a cyclical downturn.
And on that note, let's leave you with the most critical, immediate monetary policy signal you should be tracking. Tomorrow, we have a widely expected 25 basis point rate cut. That's largely priced in. The real volatility is in the Fed's forward guidance.
Specifically, how the Fed frames its 2026 rate expectations, and critically, the pace of balance sheet runoff. Any shift toward a wait-and-see stance or any hint that the balance sheet reduction might pause sooner than expected, that sends a powerful signal.
A signal that the system is still liquidity dependent.
And potentially more fragile than the calm tape suggests.
That shift in balance sheet communication, a direct measure of liquidity, could reprice long-duration assets very, very quickly, especially in a financial system that's increasingly reliant on those opaque synthetic capital buffers we talked about. The guidance on that balance sheet, not the rate cut itself, is where you should focus your attention this week.